Welcome to the Valmika Property Investing Podcast, where I, your host, share the key to success in the Australian property investing market. I'm the founder of Valmika Buyers Agency. You can find us at valmikaproperty.com. The contents of this podcast are the personal opinion of your host and are intended for entertainment purposes only. Any financial advice must be obtained from your trusted financial advisor or a qualified professional. On today's episode, we discuss the pause from the RBA during the week and why does the market think that there are more hikes on the cards. So to take that further, we'll discuss the RBA and the negative real rates dilemma that it finds itself in, how the RBA uses real rates to control the economy, and how real rates affects the Australian property market. Before we get going, let's go through the auction results for the week ended the 9th of July, 2023. So another strong showing this weekend for the New South Wales market with a 72% clearance rate, which is 7% up from last week, and Sydney showing a 75.6% clearance rate, which is a 8.5% increase from last week. So very, very strong market in Sydney. Moving on to Queensland clearance rate on a state level was at 63%, an 11.5% increase from last week. In Brisbane, showing pretty strong results for this week when compared to last week, being 9.6% up, and that's a 69% clearance rate. South Australia is still the strongest clearance rate in the country. So the state of South Australia clearing at 83%, which is a 9% increase from last week. And Adelaide leading the pack there at an 86% clearance rate, which is 11% higher than last week. Victoria state auction clearing at 70%, with an 8% increase from last week, with Melbourne showing a 73% clearance rate and a 9.5% increase from last week. Western Australia is still struggling a bit, with a 33% clearance rate, auction clearance rate, which is down from last week, around 4%. And taking Perth as an example there, also 33% clearance rate, and that's 0% change from last week. Okay, so moving on to the topic of this podcast, what happened during the week with RBA? So they were on pause, which was a relief from the market. However, economists predict that there are more hikes on the cards, but why? So when you look into the detail, RBA has a negative real rates dilemma. But what do we mean by real rates? What are they? So real rates or real interest rates are nominal interest rates adjusted for inflation. So let me explain what that means. So if we take the cash rate in Australia, it's sitting around the 4.1%. Inflation, the last inflation print at the end of June is at 5.6%. So the real yield is the difference between the interest rate set by the RBA and obviously along the curve, along the market, and the actual inflation rate that the market is experiencing. So if we take the cash rate of 4.1%, we subtract it from inflation of 5.6%, it means that real yields are actually sitting at minus 1.5%. So they're negative. But what does this mean? So the best way to explain what negative interest rates mean is to go into how the RBA uses these real rates to control the economy. So let's take an example. If we look at economic slowdowns and we use the pandemic, 2020 when there was a huge economic slowdown, and the GFC back in 2008, 2009, where there was a huge economic slowdown. What the reserve banks around the world did was they cut interest rates aggressively. So what they try and do is they try and move the cash rates below inflation. So what that means is they make the access to capital very, very cheap, lower than inflation. So this creates stimulus in the economy and gets the economy going. So because consumers have more disposable income, they're paying less on their mortgages, they can go out, they'll have more cash to go and spend and spur on the economy. And the same goes for businesses. So they're able to get cheap funding on the back of debt. They're able to use that capital to grow their businesses, so it stimulates economies. So real rates are a means to stimulate economies. So negative real rates in particular are very stimulatory because it means that access to capital is cheaper than inflation. So it implies growth. So negative real rates are very stimulatory. Now, obviously, the opposite applies. So if you're in a hot economy where inflation is running out of control, reserve banks around the world will increase interest rates so that they can get positive real rates. So if your cost of capital is higher than inflation, it's very expensive. So it deters from consumer spending because their cost of funding goes exponentially higher. This is on the back of their mortgages. Obviously, they've got less disposable income, so they go out and they spend less. It also affects businesses because they get less profits from consumer spending. Their access to debt funding is also more expensive. So it basically makes them pull back from investing and it slows down the economy. So this is how the Reserve Bank controls economies. So if we take this back now to the Australian property market, you can understand now that we're still in a negative interest rate environment. So that implies that we're still in a stimulatory environment. We're not in a constrictive environment yet, which is a problem for the RBA because they've hiked quite a bit and they still find themselves in negative real rates territory. So if we use an example where we compare ourselves to the US, so the US cash rate equivalent is called the Fed funds rate. And that's at the moment sitting between 5 and 5.25. So I saw the last reset rate was at around 5.08. So let's take Fed funds rate at a level of 5.08. However, inflation in America is sitting at 4.03%, right? So that means that real rates are positive. If you take Fed funds rate less inflation, it's a positive real rate environment, which means it's in a constrictive environment. However, in Australia, we're still on negative rates, which is a stimulatory environment. So when you compare us to the US, we're still in a stimulatory environment, which is very worrying for the RBA. Hence why they're saying that there's still room for interest rates to go higher. But how did we find ourselves in this situation? And it's all got to do with how the Australian economy differs from the US economy. So mortgages in Australia tend to be floating interest rates, with the market maybe hedging themselves and fixing interest rates for a period of 3 to 5 years on average. However, in America, when mortgages are issued, they're fixed for the tenor of the mortgage, which is the norm there. So that means that mortgages in Australia are more sensitive to interest rate movements than in America, because America it's mostly fixed, where here it's mostly shorter term fixed and floating. So we're very sensitive to interest rates compared to the US. And on the back of this, the RBA has been a lot more conservative when compared to the Fed rates, compared to the Federal Reserve in America, because of this interest rate sensitivity that we have. So Philip Lowe has given, the RBA governor, has given the Australian market time for it to catch up with the level of interest rates. So he's waiting to see if real yields will turn positive on their own. And what do I mean by that? He's hoping that inflation will drop below the cash rate and make real rates positive on their own and slow down the economy conservatively like that on the back of it. So what does that mean going forward? If it doesn't work out and inflation remains stubborn in Australia, then we will have to hike. However, if real rates turn positive on their own, with inflation coming off on its own, then you won't need to hike as much. But when we compare ourselves again to the US, who already have real rates, they still have a concern that there might be inflationary pressures increasing in the system going forward because of the strong wage market. So they are determined to hike rates even further and increase real rates even further to make sure that inflation comes down. And because they're the biggest economy in the world, they tend to drive the way things happen around the world. And if the US is going into a hiking cycle or still continuing their hiking cycle, there's a good chance that we will as well. So this obviously has got negative implications for the property market if it does. However, as you can see from the auction clearance, there is still a shortage of supply in the market. Anecdotally, I went to a few auctions this weekend, and what real estate agents tend to do is they will show a guide price where they think is towards the lower end of the range of the value of the property. And this is all a means to attract bidders to the auction. I found that the auctions this weekend weren't incredibly strong. So eventually, when they got opening bids, they didn't run away and get emotional like they do in a hot property market, which is why I still think the threats of further rates going forward might actually cap prices at the moment. And when we do roll in from fixed rates to floating, which there is a large maturity of mortgages that are doing that in October, you might see an increase in supply of property in the market. And if that happens, that will definitely cap things where they are. But we'll see, because as I mentioned in previous podcasts, it's a balancing act. We still have a large immigration catch-up that is happening in our economy, and that would just mean that there is an increasing supply shortage. So it's the balancing act between immigration versus interest rates that are interesting to see how will play in the property market. But as always, I'll keep my eyes and ears close to the ground, and will keep you informed as to what I'm seeing in the market. Hope you enjoyed today's podcast. We'll see you in the next one. Thank you for joining me on this episode of the Valmika Property Investing Podcast. I hope you found our discussion insightful and empowering. If you're interested in finding out more about our services at Valmika Buyers Agency, visit our website at valmikaproperty.com. There you'll discover how we can assist you in making informed decisions and achieving your property goals. See you on the next episode.